Hey, Tyler, 3M just reported earnings. We've talked about 3M before. We've done a couple videos focusing on the material risks the company faces and investors really need to be conscious of. So we got the earnings report. Not really a lot to be said about what's going on with the ongoing litigation with the forever chemicals, the PFAS, and the headphones with the hearing loss with U.S. military personnel. But the stock fell. It's stock down about 12% as we're recording this, about midway through the day they announced earnings. You ready to talk about what's going on? It's got the stock down and where investors need to be thinking about 3M?
Yeah, it was an interesting report, and not in that like anybody was disappointed in the current report, but as is more typical with drops like this, it has a lot more to do with what management said afterwards and the things that they were guiding for in the future.
I'm Jason Hall. This is Investing Unscripted, and this video is sponsored by The Motley Fool. If you're looking for even more great stock ideas, go to our special link. Go to fool.com/unscripted. The Motley Fool is going to give you its 10 best stocks to buy right now. Be sure to check that link out after this video. Okay, Tyler. So again, talked about how much the stock is down, but how much it's down over the past trading. But I want to share a 10-year chart because holy cow, doesn't this put it in perspective how much this business has struggled? The stock price after today's drop, after earnings, it's down 3% over 10 years. That's including the dividend. Tyler, if we back the dividend out, the stock itself is down 30%. You compare that to S&P 500 over this past decade, that's a brutal opportunity cost. What's happened?
It's been this long, slow train mediocrity to be, I guess, to not be too gentle and dance around it too much. But this is a business that for years and years was well known for creating products out of a deep bench of research and development. And 10 years, maybe even 15 years ago, you started to see some kind of deteriorating results from its like organic growth and kind of bringing products to market from its research and development arm. And you started to see things like acquisitions, not necessarily something that they were really good at and not think that they had done a lot in the past, but needed to do something to show growth. And so acquisitions became the way to do that. As a result, a lot of inorganic growth is expensive. I think you and I are in agreement of that. If you are acquiring growth, the cost of capital to do that is immensely greater than organic growth in almost any situation. So this kind of sets it up where you're acquiring a lot of businesses, and if you're making a lot of acquisitions, you may not necessarily be doing all the things to execute effectively to integrate them into your systems, corporate culture mergers, things like that. A study I love to cite is from the Harvard Business Review. It basically says upwards of 70% of mergers and acquisitions fail to create value. And when you run up against odds like that, it's like that meme on the internet, 70% of the time it destroys value, but it could work for us. And that's been the case. It's been the case with 3M. And as
I'm going to bring up some numbers to back that up, Tyler. This is through 2022. I've removed 2023 because it's so bad.
Let's keep in mind, this is from a massive write-down related to litigation. That's why that's the case. So this is why it's
exactly. So that's exactly why I wanted to adjust that off to go back to 2023, or through the end of 2022 and exclude last year because of that. But I want to also show how it's carried over to not just the returns, but how that's affected the margin profile of the business. We've seen gross margins decline from closer to 50% to now the low 40s. Is the company's innovation is not really creating barriers to entry. They're not out competing. They don't have a lot of IP that's necessarily creating value for them to be able to have pricing power, Tyler. And their operating margin has nearly fallen in half as a result of that. And when you start seeing your operating margin fall, even as revenue is growing, but it's not growing much, you lose operating leverage, your profits fall, your cash flows fall, you're no longer creating value for your investors. And then you bolt some lawsuits, which we're going to talk about in a minute, some serious material risk from litigation from past actions and products and the harm that those products allegedly have caused. You have a pretty ugly situation.
Yeah, and we can't even really talk about it, at least management certainly can't talk about it too much because it's ongoing litigation. You can't really talk about it on conference calls and what kind of impact it's going to have. As you mentioned, and as we alluded to with the decline in returns, is that they took a huge write-down, tens of billions of dollars, to cover what it believes are going to be the liabilities related to this. But I don't even think we have to focus on it too much. We know it's some existential risk and it's something that's keeping the stock down, but let's just focus on the operational performance here, because this is something that's been going on for now. It's 2024. This is 6 years. And I feel like I have been reading stories about the 3M turnaround and restructuring for 6 years. Oh, once they get their margins figured out and once they get all this restructured in the right way, we're going to see material improvement. That was written in 2018. We're 6 years removed from that, and we have not seen that happen. Now, I did a little truffle pig searching and digging before we did this. And I actually went into the proxy statement. I was like, is there any chance that all this stuff that they're saying is we're going to pay it lip service, but what really matters to us as management and how we get paid is a little bit different? And that's been the case. If you look at management's incentive program, they're incented for revenue growth, total operating income, not margin, total operating income, and free cash flow conversion. Now, those sound nice, but I'm going to paint the worst case scenario for you of what that kind of compensation package can be. I'm going to grow revenue at all costs, which means I could bolt on a bunch of low profitability businesses to grow revenue. I'm not going to really care about.
You can spend $1 to buy 95 cents worth of revenue and still hit your goals on revenue growth, doing that sort of thing.
Same thing with total operating income, because it's just operating income. It's not net income. I can use a bunch of leverage to do that. It doesn't really matter what the actual returns are because it's just a total number. And then free cash flow conversion just basically means if I don't spend a lot on CapEx, then the free cash flow conversion number looks really good. So I've got an underinvested business where I'm making a lot of serial acquisitions. And that's what management is essentially paid to do. And that's what we have seen.
You're building a compensation plan that creates incentive to grow revenue at all costs and potentially underfund investments in your business to maximize free cash flow, because you're not spending on CapEx to improve facilities, maintain facilities, expand. So you're really creating incentive for people not to do the best thing for the long-term incentive for the business.
And not for nothing, but typically acquisitions don't count against free cash flow. Another reason to use acquisitions to make it happen.
I'm going to share their guidance for 2024. Definitely a big part of what affected the stock, expecting adjusted organic sales growth. So again, this is excluding acquisitions, flat to 2%. So they're leaning into growth and not growing. Adjusted earnings per share, $9.35 to $9.75. This is coming off a year where there was $9.24 was their adjusted number in 2023. And they're saying it's going to grow a tiny bit at the low end of the adjusted range. But again, this is adjusted. So this doesn't include any of those potential litigation expenses related to PFAS, the Combat Arms earplug settlement. And again, using that adjusted free cash flow conversion metric, which sounds really good now. You're cutting off future investments in the business to maximize cash flows today. And we've seen with other businesses, Tyler, where that has been absolutely devastating. Intel, for example, a company that underinvested in their infrastructure for years, was massively profitable, high margins, lots of free cash flow, great dividend, growing the dividend. And then what happened? Their competitive advantages completely eroded because they weren't investing enough in R&D. They weren't spending the capital. And here we are where Intel is a shell of its former self. 3M, Tyler, it's the same thing. A lot of investors are looking at this as a turnaround stock, a high yield stock. Where do you stand?
I don't want to pull out your favorite quote. This company for 6 years has showed us who they are. They are not a business that has shown it can turn itself around. It mentions restructurings. It says all the right things, but none of this has materialized. We can chalk it up to COVID. We can chalk it up to interest rates. We can chalk it up to this, whatever you want. You can chalk it up to something, but it's been 6 years, and eventually something is going to have to change materially in the way that they conduct their business, and not just window dressing changes, for this to actually be a true turnaround story. And I have not seen that. You could say the healthcare business spinoff is going to be that. It's going to be, once we get rid of this liability overhang from all of these cases against us, until management really bites the bullet and says, we're going to reinvest in this business. We are going to probably cut the dividend because we need to free up some capital to make the investments that we need to do to get this business.
I know that sounds like heresy to a lot of investors. This is a dividend king. It's 50 plus years of raising that payout every single year. But this is a company that has some serious issues that it has to deal with. I think you have to think about cultural concerns too, because a corporate culture that with PFAS, for example, I'm going to lay this out there. There's some evidence, again, this is alleged, but there's some evidence out there that a lot of the companies that have been producing these forever chemicals have known at least had some inkling of an idea about the potential repercussions and environmental harms, risks of health effects on people that are exposed for a very, very long time, yet continued to produce, market, and sell these products, has to raise questions about corporate culture, right?